right, everybody, we're going to go ahead and get started. I'm going to try to give my attention here, and then I'm going to give my attention over here too for our folks that are actually here at the branch. I'm going to be kicking us off and talking about our first-time homebuyer program that we offer here at OC Federal. And I really want to welcome everyone, and I want to say thank you for joining us today for this seminar. Whether you're just starting to think about buying a home or you're ready to begin the process, I gotta say we're excited to help you guide you on your path to home ownership. Purchasing your first home is one of the most important financial and personal milestones you'll ever achieve. And our goal today is to make that process simple, understandable, and more importantly, exciting. And I hope you guys can feel that as well. I'd like to introduce two experienced loan professionals who will be helping lead today's seminar. Okay, so Cassie and Bill, together they've helped countless families and individuals navigate the home financing process and turn their dream of homeownership into reality, which is awesome. So they will walk you through the lending side of buying a home, explain your financing options, and of course, answer any questions you may have to make sure you understand what programs that we have here at OC and what they do, and make sure that they're available to you. Throughout today's seminar, we'll cover the key steps involved in purchasing your first home. So those key steps include understanding your budget, right? What down payments and terms mean, getting pre-approved for a mortgage, exploring loan options for first-time homebuyer programs, completing inspections and appraisals, finalizing your home and preparing for closing, and then finally receiving the keys to your brand new home. We'll also discuss many of the benefits and perks available to first-time homebuyers. We'll talk about tax advantages of ownership and building long-term equity and creating a place you can truly call your own. All right. So by the end of our time together, you'll have a clear understanding of what to expect throughout the home buying journey and the confidence to take your next step towards owning your first home or owning another home in potentially. So thank you again for being here. I want to say a big thank you. And now let's get started. So please join me in welcoming Bill and Cassie. And I'll be kicking it over to Cassie to go over the first couple of slides. And then Bill will go ahead and round us out. If you have any questions, please feel free to ask me at any time or ask anyone anytime, or write it in the chat because Bill will be looking at the chat. So Cassie, without any further ado, I'm going to go ahead and pass it to you. One second. Go ahead and move this over. Okay. 1 second here. Let me stop sharing. I'm going to go ahead and share. Okay, go ahead.
All right, so I'm going to kick it off with our Home Ready program. So it's basically a flexible mortgage solution. Basically what it does is, just like most people have heard of with FHA, it's really targeted towards low income borrowers as well as first-time home buyers. So the ideal Home Ready borrowers, they can be first-time or repeat home buyers. They can have low income, limited cash for down payment, supplemental boarder or rental income. And they go beyond the affordability to deliver confidence and flexibility for both lenders and borrowers. And something great that I'd like to notate is, with this specific program, you can get a down payment as low as 3%. You know what I mean? One second, guys. All right, now I'm going to go over some key definitions, things that are important to know, especially if you are a first-time home buyer. So the first one is going to be private mortgage insurance. Most people know it as either mortgage insurance, PMI. We've all heard different variations of it. So basically what that is just insurance that is required when your down payment is less than 20%. So basically if your loan to value, so whatever the home values back at, it's if you don't make a down payment to get it down to about 80% or lower, it's added on to it. So the next definition that I'd like to look at is debt to income ratio. So that is just the percentage of your gross monthly income, and it goes towards the debt payments. So conventional loans typically require a debt to income ratio below 43%, unless you have compensating factors like high equity or excellent credit. The next definition is going to be loan to value, or LTV. So this is just the ratio of your loan amount to the home's appraised value. So the lower the LTV often means better rates and no PMI. So just taking it back to the private mortgage insurance, that's what I was referencing when you are below the 80% LTV of the property. So you've paid down 20% of that loan. So the next one is going to be the pre-approval, which most people have heard that before. So it's basically just the lender's conditional commitment to your loan with a specific amount based on your financial information and your credit background. All right. And so these are just some benefits of specifically the Home Ready program. So they have flexible funding. You, again, with that low down payment of 3%. And then you also, so this program allows us to reach out to more borrowers. So again, it just kind of connects things with specifically like low income or first time home buyers that don't have a lot of money set aside for a down payment, but are ready to get out of renting. Another benefit is it does have affordable mortgage insurance. And something great about the Home Ready program is you can get out of the PMI. So once you are meeting the guidelines too, you can get it removed. Also, some other benefits. So you do get an immediate appraisal ordered with the Home Ready. So the process just goes smoother, faster, and it minimizes majority of the delays that can come with the traditional conventional mortgage. There's also a $2,500 borrower credit. So this just expands access to home ownership for very low income first time home buyers with a down payment or closing cost assistance. Tim, my screen didn't update. Oh, now it did. Mine was just lagging, sorry. All right, so this next one is just going to compare the two. So most people have heard of FHA loans, or first-time homeowners is what it's most commonly referred to as. But this is just the difference between the two. So the big one right there at the front. So for Home Ready, they only require a 3% down payment, whereas with the FHA, it is 3.5%. And then some other benefits is with Home Ready mortgage insurance that can be canceled. You again get the immediate appraisal ordered from lenders, and you also have free geographic restrictions on loan amounts. And then the final one is day one certainty, freedom from reps, and warrants are available.
Awesome. All right. Well, great job, Cassie. So what we're going to go ahead and do now is been having a little bit of technical difficulties, but we're going to go ahead and still share the screen. We're going to actually pass it over to Bill, who's going to actually talk to us a little bit more about our guidelines for Fannie Mae. So, Bill, I'll pass it over to you.
Yeah, I want to apologize too. I could not get my camera going, so you don't get to see my mug, which might be a good thing actually. But yeah, I tried. I got to get with IT, but new computer. So you'll hear me speak and not see my face. Start off with some of the guidelines, like as Cassie was saying. So down payment, you need at least 3% down for Fannie Mae Home Ready. and standard loan programs for single family homes, as long as it's a primary residence. If it's not a primary residence, they do require at least 5% down. When it's not a primary residence, there's other, which we'll get into, there's other things involved as well. The programs do allow for gift funds from family members. If you don't have enough money saved up, there's just, it's a gift fund affidavit, and you would just need information from that person handed you a gift. There's no maximum on that, or as far as how much they can gift you. It's whatever that they feel that they can gift you. So any family member can gift you money for your down payment. I know a lot of people now are doing that with weddings, where instead of getting a wedding gift, they're getting a home gift now. It's like they do like a GoFundMe page for homes on Facebook lately. I've been seeing some of that going on. As far as credit scores, that is correct. 620 is usually the lowest. And in talking with some of the people who handle VA, VA is a little different. VA will take credit scores. It's more about your military status. FHA, they can get down to 580. It's a little different, but as Cassie was stating in there, some of the differences with compared to FHA and the Fannie Mae Home Ready is where you can't cancel the insurance. There's other insurance premiums also that you have to take out through FHA. There's upfront insurance plus monthly payments that you have to make. But if you can qualify for better rates with with a lower PMI with a higher credit score. So that is one thing that does take play in that.
All right, let me get you to the next slide here.
Mm-hmm.
All right, go ahead.
All right. A credit history. One first things on there with the credit history is, yes, it's true. You need to wait up to 7 years after foreclosure to take out a conventional loan. They do go back 7 years in the bureau and look. Usually they'll fall off. Chapter 7s are a 4-year waiting period for you to qualify. You may want to consider an FHA loan if you want to buy a home sooner with those two conditions, if you have those two conditions. So only 2 years after it's 7, that's a 13. So only 2 years after a 13 says 7. It's 2. There's a 7 is 4, a 13 is 2, and 3 years after a foreclosure. Debt to income ratio, as it's stated, what a debt to income ratio is really quick is they take your debts and your debt payments, not your total amount of debt, divide that by your income. You want to be anywhere from 45 to a maximum of 50%. If you have higher credit scores and a little more cash reserves, they normally, I've never seen anything below a 50% at times there is, but they're going to look at your overall picture. But 50% is the max on debt to income ratio through Fannie Mae and Fannie Mae Home Ready products. Mortgage reserves, you'll need those when you're looking at more of an investment property or a second home. They do want to make sure you have a certain amount of reserves to cover any kind of maybe you got home renovations you need to do, or for payments, so you're backed up just in case something happens where they think possibly you might not be able to make a payment. So they're going to look and make sure you have reserves. That is not for primary residence. There's never a reserve qualification, but it is for second homes and investment properties.
All right, and then we're going to tee up the last slide here.
Okay.
All right, bring us home.
All right, so income. 2 years of employment is required. Even if you've worked at 5 different places, we need all 5 different places' addresses. So they want to see 2 years of work requirements. You can still get a mortgage with a new job. And again, they just want to see a full 2 years. Self-employed, you have to be self-employed for 2 years. We got to get 2 years of taxes. It's rare they'll accept 1 year. They're going to look for 2 years, and what they're going to look on that is that they're going to look at your profit and loss. They used to add a lot of things back in on your taxes when you're self-employed. They do not do that anymore. Some lenders might, but Fannie Mae guidelines are there's only a couple deductions you can add back in as far as expenses are concerned. So they're going to look at that bottom line profit loss on line 31. And then again, they can a lot of times add back in depreciation, but most places cannot add back in expenses like they used to do back before things happened in 2008. The Home Ready does have an income limit. It's 80% of the median value, the median income in your area. Every area is different. So if the median income in that area is $100,000, the median income they're going to go to is 80%, which would be 80,000. So that'd be the max income you can make to qualify for Home Ready. Loan limits, there are loan limits with FHA, depending on what you're looking to buy. The loan limits with Fannie Mae, that's just the max you can go before you got to get into what they call a jumbo loan. $806,000 is the max for a single family home in most parts of the country. Some areas of California, New York, they're a little higher. And there's high balance loans, and then there's jumbo loans. But the jumbo loans are going to be anything over 806, and that has I think I'm trying to remember what that changes yearly, and there's a max on jumbo loans as well. Tim, I don't know if you know what that max is or not. I think it's like $1.2 million or something.
Yeah, last time I checked, we're about $1.2 million, I think,
Right.
is what I saw. So I don't think you're off there.
Yeah, and it's different for every area. Every area is measured differently. You're gonna have to pay, the only thing that's an out-of-pocket expense on all mortgages is your appraisal. We always look for $500 up front. If it comes in less, we just refund you back that money or put it as a credit towards your closing cost. All Fannie Mae loans are gonna require, most of them are gonna require you to have you're gonna have to have an actual appraisal done. It's rare that they will do a property inspection waiver. It can happen depending, but most of the time you're looking at we require an appraisal on every loan. Government-backed VA loans, USDA loans, they all require appraisals regardless how much money you're putting down. Title, Fannie Mae requires a search of your property's title history, insurance free of any ownership claims, such as unpaid property taxes, unpaid liens somebody may have had on other loans. Title insurance is required to cover the sales price on the purchase of the loan or any amount in Fannie Mae. Title insurance, it covers you. So once the loan is done and completed, that title insurance covers if any other encumbrances come on that title, then they can get rid of those encumbrances. That's why the insurance pays for it. So if something 2 years later were to happen where they find some lien, they can't lien your home. And if they do, that's what the title insurance is used for, is to pay that lien and take care of it.
All right. Well, thank you guys for presenting. So now what I'd like to do, and we do have a few on and we have a few in here, would love to see if there are any questions that maybe you guys have. Perhaps we can answer them for you. If you want to write in the chat, I know Bill's looking at the chat, so if you want to type it in, that's fine too. But I just really want you guys to leave here with all of your questions answered. And again, more of a direct line to you guys buying a new home. So I'll open it up to anyone that may have questions. I know we had some typed in a little bit earlier. Bill, was there a question or two maybe that was asked?
Yeah, one question was what documentation is needed for a pre-approval? To do a pre-approval, we got to put in an application, of course, your job information, your living information. We'll have pull credit. And then what we look for the pre-approvals is in 2 years W-2s, a month's worth of recent pay stubs, bank statements showing where you're going to be getting the funds for your down payment and closing costs, and IDs. Excuse me. Those are usually the basic things we will need for pre-approval. If you're self-employed, we need 2 years taxes. And that's basic. From there, we can look and see what you qualify for within your credit score and within your income limits. Any questions on that? Okay.
All right, Cassie, was there a question that came in through you or no? No, we had a couple questions emailed in. Probably not. You're muted.
I'm sorry. I had another question too.
Go ahead. Yep.
A person asked what points are. What do points do? Points are paid for. We don't charge any points on our loans. Points are a lender thing. Points are paid for if you want to bring a rate down. That's all they can be used for now. Back in the day, places would charge you points as a fee. That's not correct anymore. Usually what it normally is for every point you pay, it's usually about a quarter point drop, quarter to a 0.35 drop in rate. So a lot of people ask how they want to get their rate dropped or how they want to get the rate lowered. You can pay points to have your rate lowered. That's part of the closing costs. And that's a discussion you can have with your loan officer and yourself. Rates are a little higher right now with what's going on out there in the economy. So some people are looking towards possibly paying some points to lower their rate, but that's what points are. And we get that question a lot, and how they're used.
Yeah, we do. Good. Unmute. Cassie's got a question that was emailed.
Are you able to hear me with it like this? Okay, perfect. So it was, what are the most common financial mistakes first-time home buyers make before closing? And to just touch base on this, so it's going to be things like touching credit. So like buying furniture on a credit card before closing. You don't want to do that. You don't want to drain your savings before closing. And this is already, you're going through the process. You've got your documents approved. They've already approved credit. But right before you go to close, they do that final check of credit and they see that you took on a new debt. You got an auto loan. You don't want to do things like that. You just want to make sure that while you're going through the process, you're not making any new large purchases, withdrawing a bunch of funds for something, or just adding any new debt or credit pools to your credit history. You just want to make sure you're just sticking with this one transaction, seeing it through, and once you're finally closed, then you can go back to your regular financial decisions you would make. But while you're going through the process, you definitely want to just keep it to the minimum for sure.
One other thing I'll take off that, continue off that, is one thing she did bring up was about draining your savings. They look for 60-day seasoning on funds. The reason they did that is they don't want you pulling out cash out of your mattress the day before closing and pay for your closing costs. No, you have to actually, because of the things that happened in the 07 and 08 crash, you have to source those funds, and those funds have to be seasoned for 60 days in a real bank account, not your mattress or in a paper bag under your bed, which I've had people ask me about. So I've had people ask me about straight cash coming to close. So just remember that if you're getting ready to buy a house, and that's not a problem if you're saving cash, but remember that cash is going to have to be deposited into a financial institution of some type, even a investment account, and it has to be seasoned for 60 days. So just wanted to tag team off what she was stating, what Cassie was stating.
All right. Well, I don't know if there's any other questions we may have here or anything over on your guys' side of the house, but hopefully we were able to answer, or at least give you some of these answers that you might be thinking about, maybe even haven't thought about as you start to go down that journey of home ownership. So here at OC, you guys have now a name. You have a face that goes with the name. You have Bill, that's just the name. But, you know, you can always reach out to these guys. They'll be more than happy to just assist you in any way, shape, or form. And we'll be able to walk you through those next steps, get you that pre-approval, and get you those keys to the home. So I want to thank you all for joining today and being a part of this. We'll continue to do more of these as we go through the year, and you'll certainly see an invite. So if this was something you're interested in, and as you get your new home, you want to buy another home, there could be some seminars that we're going to offer for you guys as well, and be able to assist you there. So thank you so much. Enjoy your evening, and really appreciate you guys being a member of the credit union. Thank you so much.